As I'm looking at the U.S. markets, top performers, worst performers. Palo Alto Networks is one we actually reviewed before. It was super expensive. You know, if we looked at Yahoo Finance and looked at PANW, this is an example of a stock that has a product. They do cybersecurity, and they have a product that businesses absolutely need, and companies have to fork over money for this. And so it's a lot like the business of bug extermination. You absolutely need it, so you can actually charge a premium for that. Because whenever something goes bad, you got to do something. So let's look at the statistics we have a PE of 43. That's what we get from this page. Let's look at the statistics according to Yahoo Finance. They say the PEG ratio is around 1 right now. All right, so that means it's almost fairly valued with a PE of 50. Let's look if they're growing at 50%. What we're going to do is we're going to divide the year over year, 4.44 divided by 5.51. So that's 20%. That's 12%. Okay, so they're growing around 15%. If you divide the years out, let's see, look at the last year. 7.32 divided by 9.6. That's 25%. So let's give them a break. We'll say they're growing 25%. Okay, and according to Yahoo Finance, their PE is 50, so their PEG ratio of 2. That they said 1.25 here. I think it's around 2. So they're still double the price they should be. They actually, if we look at their chart, they went down 30% this week. So if we look at the stock chart, this is an example of stock that I put on my radar as, this could be a stock we could purchase and follow. But you see that drop of 30%. They disappointed on their earnings, and you can see that they came down to a level of support right here that they had support back in beginning of this year, January. And if they fall further, this is the next level of support, and this level and this level. So they basically hit I think it's their 200-day moving average. So you can see how powerful the 200-day moving average is. It's like a floor for stocks whenever there's a growth stock, and that's you can see that they're oversold, and that's why they're bouncing today, because they had a lot of support there at that 200-day moving average. So I thought it'd be interesting to go through, one of those stocks. I didn't have prepared for today, but it was on the top, of the list. Maybe there was an upgrade today. People were getting excited because of an upgrade, but so the theme for this is it's still double the price of its growth rate, but there's a steady demand. So if we look at our E-Trade earnings summary, you can see it's a straight line. It's exactly what we're looking for in a stock that's a growth stock. And the best time to buy something like this is when it drops 30%. So that drop, you can see, if you were interested in buying this, you would wait till it goes down to its 200-day moving average, and then buy it, and then maybe see if that holds right there. So anyway, that's a good exercise. Let's go through some bigger picture things. The S&P 500 went up this week, around 1 or 2%. We had a good earnings report from NVIDIA. And last week we were talking about this. Correct. Okay. Last week we were saying NVIDIA has earnings on Wednesday, and there should be a good earnings report, and we should have a little bit of fizz around that, and the S&P will go up. But now we're at a point where, and they actually did come out with good earnings, and now everyone's looking at NVIDIA and to determine where the stock market's going to go next, basically. So we look at NVIDIA. NVIDIA. Let's look at that, see what it's doing today. So it went up 15% or 16% yesterday. So it still, hasn't given back anything. So that'll give the AI stocks a little bit of support. But everything's overbought right now, as we can see from our stochastics charts right there. So we're still overbought, and we're going down in the stochastics. So the last 2 weeks of February are always the last 2 weeks of February are the worst weeks of the year, seasonality wise. We both have the worst month, one of the worst months of the year, and we have the worst 2 weeks of the year. So it very well could give back a lot of the gains that we had, just because stocks don't go up forever, and we're like in a sine wave of activity, going up and going down. We're at the top right now. Okay, so let's look at some more of the stocks going up and down today. We see, I don't see anything in common with all those. Okay, we see the ones going down, we see a lot of semiconductors going down. We have AMD, we have ON Semiconductor, Booking Holdings. They came out with earnings, they weren't so good. Okay, let's look at the NASDAQ, see if we see anything. Okay, we see a lot of cybersecurity stocks going up together. Okay. One's going down the most. Okay, a lot of semiconductor stocks. They rallied yesterday with NVIDIA, but they're giving some back today. This Marvell, ON, KLA, these are all stocks that are involved in semiconductor making and advanced microdarts. Okay, so these have all run up, and they're just giving some back today. And once, let me see, look at anything from here. All right, we don't see anything there. All right, so let's go back to our talking points. Okay, so we had a President's Day holiday. So one of my theories for holidays this week is right around holidays, usually have a little fluff in the market, and that, I don't know if it helped or not, but it went up this week. And now we're going to be the period probably of going down for a week or so. But March is traditionally a good seasonality. We have a Fed meeting in the middle of March, so whatever they say there is going to help or hurt the market. And we have let me see. We have, no, we don't. We have a holiday coming in March. I don't know what the heck that holiday is, but it's coming up, so we can always look forward to a good time around there. All right, so let's look at some of our other, okay. NVIDIA reported earnings. They were better than expected, and that helped the stock market up this week like we were thinking. And right now, 72% of the S&P is still above the 200-day moving average. So that means we're still in an uptrend. And so the stock market in general is still going up, even if we correct a little bit. The treasuries are up 2%. Usually when the treasuries are up, the stock market goes down. So that's a little hint that we might be going down in the near future. All right, so catalysts for the stock market going up. We don't have anything really. We have the Fed meeting next month. That's about it. And we're done with earnings for another quarter. So we have to wait for a couple months before we have earnings again. So there's nothing. That's kind of why February is a so-so month. Right now for the next 2 weeks, there is no earnings. Nothing to excite the stock market. Okay. So we're going to have a lot of economic reports for the next month or two. So that's going to be our things that the stock market goes up and down about. All right, so we're going into March, which is traditionally, March and April are both really good months, and May. And then we get into the summer doldrums. People say sell in May and go away, because the summer is traditionally a bad set of months to be investing or expect good numbers. All right. So I already mentioned the S&P is at the top of its range, so most likely it's going to come back down to here. I don't know what the catalyst is for that, but We already talked about the 10 years losing its correlation. So interest rates are becoming less and less important to the stock market. Earnings are more important, it seems. Everything is pretty much the same as last week in all this. The dollar index went down just a little bit, so that helps the stocks of the stock market. And fear and greed. We are extreme greed right now. We had a 16% increase in NVIDIA yesterday, and we have people buying calls more than any other time in history. So this is all indication that the stock market is going up in the near term. But that's not the time to buy, though. That's the opposite time. You want to either sell or don't buy when it's like this. And we also have more bullish than last week in the AII sentiment survey. So whenever people are bullish, you have to be very cautious. Right, so, and the VIX is really low too. So it's not, whenever VIX is really low, people aren't afraid, and stock market usually slowly goes up. We had two things in our possible crash scenarios happen this week. We were wondering if NVIDIA reports bad earnings, the stock market could go down, but they didn't. They reported good earnings, so that takes that problem off the table. And AI stocks are not bursting anytime soon because everything is riding around NVIDIA's coattails. And the Magnificent Seven stocks are still being bid up, and they're not going to, it doesn't seem like they're going to be going back down to their fair value. Everything else is under control, so it looks like this is all an indication the stock market is pretty steady. It's going to be, whenever you have, no major problems in those major factors, you have like a steady uptrend where it goes up and down in this channel. Now, it's only whenever one of those happens, the news stories takes center stage, that we get a correction out of this range, I think. But that's my theory. I don't know. It's been working. Okay. So, so we're 15% above the average of the S&P 500. So a correction of the S&P 15% would be bringing the S&P, the stock market, back to a normal range. So it's very possible with a bad news story we go down 15%, but you have to be ready for that. The first to worst, it's getting very interesting. At the beginning of the year, we were looking at the worst and the best performers of last year and how it compares to, this year. And so it seems like utilities are still not doing good. That's primarily because the interest rates aren't going down as fast as expected. And real estate and utilities are heavily dependent on interest rates going down. But you can see that healthcare is becoming an outperformer along with financials. Both of these are breaking out in our charts, in our stochastics charts, and in our individual stocks. So these are it's a very good possibility that both the financials and healthcare are going to start being the outperformers this year. And you can see that IT and communication services are still doing well. They did the best last year. So in our themes for this year, the AI revolution is taking center stage in most of the stock market right now, because most of the stocks in the S&P are involved in some way with AI, and that's leading the market. Right, so at the beginning of the year, we were thinking there'd be interest rate cuts, but they're not going to be happening probably until July or so. So a lot of these sectors, like utilities and real estate, that deal with interest rate cuts, that count on that to be profitable, they're being negatively affected, and they're not going up like every other sector. And the mortgage rates aren't going down as expected. They're still around 7%. But there's still a possibility we have a recession. If that happens, the stocks will go down 15 or 20%. So we have to watch out for that. I think that's it. All right, so I already went over the sector. Let's look at the sector ETFs. From our remarket from our see, let's look. Okay, oil is down 3% today. That's pretty big. So we expect anything involving oil, like for instance, if airlines are helped by the price of oil going down, and then you have any transport like UPS or FedEx, they're affected by that. Also, you have, whenever you have a crude going down, all the oil stocks go down with it. So let's see if that's the case here. Let's look at the sector ETFs. Okay, so the price of the oil stocks, yeah, we have XLE Energy Sector Fund going down 1%, not that much. So that's why all the oil sectors are down. Let's look at the ones doing the best. Retail is doing the best. And gold, miners, home construction. So when we looked at the 10-year, that's going down. That's a lot for a 10-year. So when the 10-year goes down, anything involving interest rates will be affected. So let's look at the interest rates. Okay, so the 10-year is going down. That means the home construction will do good because people can afford houses if interest rates are lower. And then you have home builders, of course, the same idea. Biotech ETF is they're heavily dependent on borrowing money because they're smaller companies. So the lower the interest rates, the more they can grow. Utilities are affected by that because the lower the treasury rate, the risk-free rate goes, the more in demand their yield is. All right, and financials. This is another example of the worst to first. Right now, the financials and the healthcare are becoming leaders of this stock market. So XLV is the healthcare. Okay, so that was a good look at that. Let's look at some of the talking points we had for today. Okay. I'm revisiting Dan Niles. His comments at the beginning of the year, his picks. Right now, Amazon is up 15%, Meta is up 37%, and XBI is starting to outperform. His idea for XBI, it's the biotech ETF. Healthcare was underperforming for 3 years, and it's a return to the mean. So right now we have interest rates going down, so a lot of these biotechs need to borrow money, and that's helping them. And the sector is doing good too, the healthcare sector. So I'm going to look at some of the sectors right now that are breaking out. Healthcare. You can see we were in for 2 years. We were in a sideways pattern. In January, we realized, wow, this is starting to break out. And you can see a lot of the stocks that we're following in the biocare and healthcare, pharmaceuticals, they're going up. So let's look at, okay, so you can see the XBI is part of that industry. And so it's starting to go up. So this might be like an outperformer this year. All right. So we're going to, next time Dan Niles talks on CNBC, we're going to listen to him, and because he's been like super good this year with his top picks. Okay, so what I did was I was looking through, I go through our stochastics charts every week just to plot the lines that on the charts. This isn't a 100% works every time, but if enough people follow these charts and these trend lines, then it becomes true because people used algorithms to actually trade this based on these chart patterns. Okay, so the healthcare is actually one of the most, it's outperforming a lot of the stocks, the sectors this year, because it was underperforming for 2 or 3 years, and now those are starting to be loved. So we're going to follow up on a couple stocks that we're following that are in the healthcare that are actually parallel to this. They're doing the same, they're in the uptrend just like that. Okay, let's look at XLI, they're breaking out. This is the industrial sector. Remember that there's a bill that actually was passed by the U.S. government for infrastructure spending, and a lot of the stocks around that are going to do good, such as the rental of big machinery and companies that do a lot of infrastructure work. So we're going to keep our eye on that sector because that's almost a guaranteed money from the government coming into these companies. Okay, let's look at the financial sector. Look at this. And a lot of the financials we're following are breaking out in the same way. They were in a sideways pattern starting 2 years ago. And even with that crash last year at this time, we have this financial sector breaking out into its little uptrend here. And uranium, we saw it was down at the bottom of its channel, and the stochastics were really low. So hopefully this holds up right there. I'm not sure. It's starting to break out just a little bit. I'm not sure, but it looks like it's in an uptrend here for the near term. Eli Lilly. This is an example of a stock that's it's in an uptrend, but it's actually breaking out like the ETF chart that we were following. Okay. So on Wednesday, we had earnings for NVIDIA, and that basically ignited the global stock rally. We were saying that last week, when NVIDIA, a lot of times when one big stock that reports a good earnings report, a lot of times the stock market and rallies around that. So that's what happened. And a lot of times whenever you have an outperformance, like a 16% stock going up, the next couple of days you give that back because the true traders will wait until it's kind of popped out, and like right today maybe they might sell because that's when everyone's excited, and just when people are excited about it, that's whenever you have the stock market going back down. So for instance, let me see. Okay, so right now people are excited and they're buying their NVIDIA, and just when you think it's going to go up more, then it goes down. So you got to think opposite in general. If you didn't buy NVIDIA already, it's probably too late. I mean, it's going to give some back. So that's usually what happens. That's why I have it red here, because we're overbought. All right, so what they said on their earnings call yesterday, it was generative AI has hit the tipping point, and from this time last year, they have a 265% rise in revenue, and they went up 16%. So, but I looked at the numbers for this on E-Trade, and the numbers aren't updated yet. There's analysts are going to be like taking a couple of days to really allow this to sink in, and they're going to update their earnings estimates. But just for kicks, I looked at the earnings estimates for NVIDIA for the next couple of years, and from this year to next year, they're growing at 50%, and then after that, looks like they're going back down to 19 and 12%, which we don't know if that's right or not. So we're going to wait, and we're going to check back on this a week or two from now and see if these estimates are updated. So right now they're growing around 49%, and their PE is 38. That means they're on sale. They're basically trading at a PEG ratio of 0.77, so they're 23% undervalued, if that's all right. But we're going to check on the estimates to see if this actually changes in the next week or two. You can see that they were in this uptrend, like most of the tech stocks we've been following, making higher highs, higher lows. But right here, around 2 weeks ago, they started this new channel, and we're at the top of that new channel. And so the next stop probably is like in the next week or two, it's going to be down to here. So we're going to be zigzagging most likely in this pattern. But we're super overbought right now. We've been super overbought for at least 6 or 8 months with NVIDIA. So let me see. So just for kicks, I went through and did some research on NVIDIA to see what Morningstar and CFRA we're thinking about it now. Morningstar thinks that they're undervalued by 8%. Their price to fair value is 92, not 0.92. So that means it's 8% undervalued. They raised their earnings estimates. I mean, their price target, because their forecast was well ahead of expectations. So the difference between a forecast and the beating the earnings is huge in the price of the stock. So if the stock reports good earnings and they have bad earnings outlook, most likely the stock is going to go down. But because they had the earnings estimate, the forecast was well ahead of our expectations, that's why the stock went up 16%, because the forecast or the estimates going forward is much more important than the earnings that they made their earnings this time. So, but no one knows if people double book their orders and then it'll just exhaust itself. We know from looking at NVIDIA, it's a very volatile stock, and it went down to like $100 a share 2 years ago because there was like a slump in semiconductor demand. There was a pre-ordering and then no one ordered. If we look at the chart, this is 2023, you can see it went the whole way down to like $100 and some a share. And it was one of the best performers in the whole stock market for the last 10 years. Look at that. It was, but you can see that if you this goes semiconductor world goes in fits and stops. Like for instance, you have a lot of demand and then all of a sudden you have more inventory than you expected. Then you got a discount. So it's just a very volatile world. So if you own this stock, you have to be willing to go through these major price swings, because right now people are pre-ordering, like Facebook or Meta is pre-ordering a lot of these, and maybe next year they won't buy any. And that's going to make this stock very volatile. But in general, if you own a stock that's in a semiconductor world, you got to be ready for that. I think that's called like cyclical. It's depending on how well the economy is doing and how well that industry is doing, the demand of their chips. So anyway, that's something to keep in mind, because stocks don't grow to the sky. They eventually correct. So right now it's like a parabolic move right now, but if you so let's do that just for fun. What I'm going to do is I'm going to draw a quick chart. This is how I draw my charts. Okay, what we're going to do is we're going to draw a quick. This is a long-term trend, like that. You can see like that. This is like it's like an outlier. If there's some kind of problem with their earnings or something, we're going to go back into this channel here. You see, we have a new channel forming here, but the long-term 20-year channel is like down to here. That's like at $500 a share. So we'll have to watch the earnings estimates. We'll update our charts next week or week after. Let's look at what CFRA said. A lot of times whenever a company comes out with earnings that's a big company, they put a little note out. They have a buy recommendation on it, and they said we lift our 12-month target to 840 from 700. So that's like 20% upside. So they think it's worth 20% more than it was before the earnings report. So anyway, I think CFRA is a really good way of valuing stocks. We're going to look at one more page from this report. Their fair value for NVIDIA is 632. They said it's overvalued by 12%. So that's in contrast to Morningstar, but it's something to keep in mind, so you can't get over your skis, thinking it's overvalued, if it's fairly valued or undervalued. So we have half and half, so we're not really sure about the real value. I expected when I looked at the earnings, this was surprising. I expected like a straight line up, but they actually had more earnings in 2022 than this year. Maybe this chart is wrong. I expected a chart going straight up, increasing like 20 or 50%, but I didn't see that. But it's close. It's close. They had the same. Maybe this might need to be updated. I'm not sure. So, but I expected to see that. One thing that's important is this return on equity. This was going up for a while now. Their profit margin is something like 77% now, and that is pretty amazing. I'm going to look at that profit margin now. I think it's up to 70 after this report. It's up to 77%. That's better than most of the stocks we're following. The return on equity is 91. That's better than 13 that we normally look for. And Yahoo Finance says it's 0.77, and that matches our calculations. So it's still like fairly valued if you summarize it all, and it's growing around 40%. But the thing is, we don't know if this is accurate, if these numbers here are accurate, the earnings estimates. So we're going to check back on a regular basis, maybe a couple weeks, to see if these are changing at all. But the demand for their processors are really high right now, and they can't make enough for their clients. Okay, that was a good exercise to do. Is there any questions on that? All right. Here's some news stories. We saw this week Capital One to buy Discover. And what does that mean for customers? And a lot of times when a company decides to buy another company, it seems like it's a good thing. They get bigger, but the acquirer company usually falls, and the one being acquired usually goes up. Probably because there's uncertainty involved. Whenever you commit to buying a company, you could lose money if the deal doesn't go through. You have regulatory hurdles. You have addition to their debt. If you buy a company, then you gotta borrow money a lot of times to pay for it. So companies that borrow money and you have a lot of debt, they're not valued as much, and that's why the acquirer usually goes down. Okay, so they're saying that they could challenge J.P. Morgan as one of the top credit card issuers. J.P. Morgan or Chase, they have the largest share of credit cards in the world right now. Just for kicks, I thought it'd be interesting to go over Capital One, their numbers, and they're actually, I think you could call it like a steady Eddie kind of a company. So the good thing about Capital One, we know from our charts, our stochastics charts, let's look at the XLF. We know the financial sector has been sideways for like 2 years now, and it's starting to break out. So that's a good positive that maybe the financial companies are starting to get a bid. So that's one thing on its side. We see that it's growing around 11% a year. 11% if you add all these up and divide by number of years. So that's a huge discount. It's a PEG ratio of 1. They're growing at 10%, and their PE is around 10, 11. So their PE is 1, so that means they're fairly valued, but that's a huge discount to the other credit card companies. So let's look at the other credit card companies and this company's numbers. Okay, so first of all, we were talking about this earlier on the chat. We have credit card issuers, and then we have the actual credit card networks. They're different. So the networks are companies like Visa, MasterCard, American Express. In that case, Discover only has 4% of that market. But if you add the combined purchase volume, which is one way to see how much clout a company has, this is very close to Amex and Chase. So so that could cause this deal not to go through if this reduces competition in this world. But so the reason why this is important is the valuations of each of these sectors is different. The card issuers are valued much less than the card networks. So the card networks, like Visa, MasterCard, American Express, they trade for a higher PEG ratio. So even though this Capital One went down on the news, they could, over time, have a valuation similar to Visa, MasterCard, or American Express. So that's an example of like a stock that's kind of it could grow into one of these major credit card networks and have a different valuation. So just for kicks, I thought it'd be interesting to go over Visa, MasterCard, compare it to what Capital One looks like. Okay, so Capital One, according to Morningstar, they're like 10% undervalued, and they said they're neutral to this deal. It doesn't really. They have some synergies and they have some integration risks, but they said it was decent acquisition, and so they're 10% undervalued according to them. And this is CFRA. They said they should capture some synergies in this deal. So that it was decent according to CFRA too. But they said the fair value of Capital One is over double what it is now. And I don't know how they came up with this, but that's something to keep in mind. If they, part of my theory was, for this company, the PE ratio for this company is only 9 or 10. And the PEG ratio is less than 1, according to my calculations. So, but the valuations for MasterCard and Visa are much higher. But their earnings, it's not very consistent, so it's not like our formula for a growth stock. Their PE ratio, they haven't been treated very well in the stock market because the PE ratio is really low compared to other banks in the world. So they haven't gotten a whole lot of love, and they're kind of undervalued right now. Maybe this could be something that helps them out a little bit. I'm not sure. But let's look at their chart. You can see this. Their chart is following the XLE chart. This is the XLF chart. So you can see we knew that the financials are starting to break out right here in January. And it seems like this stock is following that same pattern. So that's a bonus. They're at the bottom of their trading range. So if they're going up like this, that could be a sign that it's close to a time to buy this if you're interested. Okay, so let's look at their financial information. We see the profit margin is really good. The return on equity isn't good right now. But they do have a lot of debt right now. I didn't expand that because they just bought a $35 billion company. Let's look at MasterCard. You can see MasterCard has a valuation like 50% more in the PEG ratio. It's 1 versus 1.5. And their PE ratio is like 10 times higher. And their profit margin is a lot better. And the return on equity is a lot better. So you can see this is an example of a network, a card network. And they don't take any risk. Most of the risk is taken by the banks that have this branded card. And that's probably why they have a better return on equity. All they do is have a toll road where the people pay tolls to be able to use their card name. And let's look at, let's see. So you can see Visa has a very similar valuation to this. So it'd be interesting to see over time if Capital One can actually get better margins, better return on equity, better profit margins if they become a network. So that's to be seen. I thought that was a good exercise. All right, let's look at the video. Okay, the video is holding up right now. Let's look at the Okay. Look at the big news on Yahoo Finance. This is one of the best websites for news about the stock market. Okay, so we have a theme here. Let's look at our calendar. It says Fed is no rush to cut interest rates. We've pushed back the interest rate cuts in our calendar for like July. Maybe might be September. If interest rates are cut way in September, then the stock market is not going to like that, because they were expecting, and the stock market could just go down because of that. And that's pretty important. You see, so NVIDIA is becoming one of the biggest companies in the world. They might, if they keep growing at their current rate, they might overtake most of the other Apple and other companies in the $1 trillion range. You see. Okay, this is what I was saying earlier. Nothing goes up forever. This rule will tell you when to sell NVIDIA stock. Okay, so NVIDIA is in a parabolic move right now. So it went up like it doubled in a short amount of time. So a lot of times stocks that go up forever, and traders would actually take a profit like today and watch it go down for the next week. And here's Supermicro. This is the company we went over last week. It goes up and down exponentially based on how NVIDIA trades. So if NVIDIA goes down, this goes down 5 times as much. You see. Okay, there are people that are saying, like Jim Cramer is saying, this Jensen Huang, he is a true visionary, even more visionary than Elon Musk. So when you invest in NVIDIA, you not only invest in the products they have right now, but he's been like seeing AI for 10 or 20 years, and he's way before most people in new products. So whenever you invest in NVIDIA, you actually invest in products that aren't released yet, that are in development, that are going to be coming out. He's coming out with new processes all the time, but Jim Cramer really thinks that he's on the cutting edge of what's going to be happening next. He has robots in the metaverse ready to go. He has a lot of new things that are in development that aren't really public knowledge right now. So this is a lot like buying a Tesla or a stock that that's run by Elon Musk. That you never know what kind of products are going to be developed and the kind of money that can be generated. So anyway, I thought that was interesting to go over that. Okay, so Walmart's going to be splitting pretty soon. We know that when Walmart splits, the value of the stock doesn't change. It just cuts the price in half. That's like having 2 cups of water instead of 1 cup that has 2 cups of water in it. So let me see. Okay, so these headlines are like pretty favored to AI stocks. So a lot of stocks like Palantir, a lot of stocks that are involving AI in general have gone up a lot in this week. So there's a lot of people piling into those, and that's just whenever it's time not to buy. So if we look at our calendar, we're right here on our chart, overbought. It's very dangerous to pile into AI companies, especially when they're not making money. And there's no real way to prove that a stock is an AI stock. Someone can come out with a news event. We're an AI stock. We're doing this AI whatever, and it's really hard to prove that. And it's like the .com industry in the year 2000. If you have the name .com in your name, it went up exponentially. And if you put AI in a press release, then you're an AI company. Then you go up. it's just pretty nuts. You have to make sure the numbers make sense before you buy an AI-related stock. Okay, so right, I think that was a good exercise. I think that's all we had to say for today. Does anyone have any questions about any stocks you're interested in, or comments about the current market environment or something? Okay, I'll take that as a no. I hope you can still hear me. All right, well, I hope you have a good weekend, everybody. What's that?
I can still hear you.
Oh, yeah. Okay, awesome. All right. Well, I think I've maxed out what I could say. I hope you have a good weekend. I'll see you next time.
Thank you, guys.
Thank you.
All right, see you.